Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/Markets Plus for more episodes.
I'm Mike Miranda, president of BMO Family Office and head of investments for BMO Wealth Management. Today's conversation is part of BMO's ongoing efforts to help clients navigate geopolitical risk with timely perspective on markets, the economy, and investment strategy. We're recording at a moment when geopolitical developments are still raising important questions for investors and business leaders. How could the evolving conflict affect the macro backdrop? What does it mean for market sentiment? And how should clients be thinking about rates and portfolio positioning in an environment that can shift quickly? I'm joined by two BMO colleagues with deep expertise in these areas. Scott Anderson is BMO's chief U.S. economist and managing director, and he'll help us unpack the economic implications. Ian Lingen is managing director and head of U.S. rate strategy at BMO Capital Markets, and he'll walk us through what this means for rates, treasuries, and the broader market lens. Scott, Ian, thank you both for joining me.
Thanks for having me, Mike.
Scott, let's start with you. Oil prices remain elevated, and the average prices of gasoline in the U.S. are well above where it was in late February when the conflict began. At what point will inflation expectations begin to influence the broader U.S. economic outlook?
Great question, Mike. I think oil price shock is already impacting the broader U.S. economy through higher prices. Gasoline, as you noted, is around $4.50 a gallon. That's up about 60% from the January low. So we know it's already impacting through higher prices. We're seeing higher prices for transportation, food, and overall goods prices. And it's also probably holding back consumption from some consumers and businesses. The U.S. and global economy is now entering its fourth major supply shock since the pandemic. And more frequent supply shocks risk being embedded into long-term inflation expectations, especially if they're combined with accommodative monetary policy, which really puts the Fed's interest rate policy in play here. So the risk, of course, is this could eventually lead to endemic inflation and stagnant growth, very much like we had in the 1970s, which was a true stagflationary event. At least at the moment, we're seeing oil prices coming back down. There's a lot of optimism around a potential agreement to reopen the Strait of Hormuz. And so we are seeing an impact from the Iran war. We think it'll probably subtract about 0.4 of GDP growth off the top from what we would have been otherwise, and probably push inflation about 1 percentage point higher than it was before the war started. But the U.S. economy has a lot of positives still helping the U.S. economy overcome these growth and inflation headwinds. One major one I think I'd like to highlight is the reduced drag from trade uncertainty and tariffs. We track a trade uncertainty index that hit its lowest level in the second Trump administration in April. A lot of our customers are looking forward to tariff refunds over the next 60 or 90 days. Of course, the president is threatening to put higher tariffs down the road for some products. But overall, the tariff drag is diminishing. You think it'll only subtract about 0.2% this year from GDP instead of 0.6. We also have the One Big Beautiful Bill Act actually is allowing a big surge in income tax refunds this tax season. That's really helped a lot of consumers, kind of overcome the shock of higher gasoline prices and continue to spend. We've got the generational growth in AI investments. The hyperscalers expected to increase CapEx this year by almost $820 billion, single-handedly driving overall real equipment spending and business investment growth. We've got record high corporate profits as a share of the economy. We've got some of the strongest productivity growth. We've seen about double what we had from 2010 and 2020, almost 3% productivity growth over the past year. And we've got business inventory rebuilding. A lot of businesses held back on importing last year because of the higher tariffs and tariff uncertainty. This year, they're actually importing more, and we're seeing that support manufacturing activity. So in the end, I think U.S. growth will look very similar to what we had in 2025, a bit less consumption growth, The downside of the war, of course, is that the Fed will likely miss its 2% inflation target for the sixth consecutive year this year.
All right, thanks, Scott. That's very helpful. Let's stay with you. As you look at the current backdrop, what should clients be watching most closely over the next several weeks to determine whether this remains a market headline or becomes something with more lasting macroeconomic consequences?
Well, the ultimate impact will depend on how long the Strait of Hormuz remains closed and whether this energy price shock bleeds into broader core price inflation beyond food, transportation, and goods prices and actually starts to upset longer term inflation expectations. The good news is so far that doesn't appear to be the case. Core inflation is going to move up a little bit, but we think it'll only be around 3% this year. And if you look at the markets and long-term inflation expectations, they're still pretty well behaved at around 2.5%. So at least at the moment, it doesn't appear we're seeing that bleed through to a broader overall inflation. So if we do get a decline in oil and gasoline prices as the strait opens up, that could be a positive development. But if we get significant escalation in the conflict that further damages energy infrastructure in the region, that could be a catalyst. And if the Fed loses its inflation fighting credentials with the new Fed chair, perhaps cutting rates before inflation subsides, that could be something that investors need to keep a close eye on. So I'm really watching the 10-year Treasury yield, the 30-year Treasury bond yield, and the potential for bond market vigilantes coming back out of the woodwork here, either because of higher inflation expectations or higher real yields due to soaring budget deficits and debt. That could upset a very, very strong stock market, trigger a sharp sell-off in stocks, could lead to corporate credit spreads blowing out, and could put the AI data center build out on pause and really put the economic expansion and consumer spending at risk.
Well, that's a great segue to bring Ian in. Scott obviously alluded to some of the recent rate volatility. So, Ian, as the rate market is facing both an inflationary environment on one hand and this higher geopolitical risks on the other, how are these showing up in treasury yields and overall rate volatility?
Well, I think that a lot of the story has been translating into what we characterize as in-range volatility. It's not the spike in volatility that we saw following Liberation Day in April of 2025, where there was simply so much uncertainty that we had a significant spike in volatility that took months to unwind. Instead, the developments in the Middle East have translated into an initial spike in uncertainty. And then as oil prices have stabilized between $90 and $110 a barrel, we have seen the rates market do very much the same. The narrative has been relatively straightforward. Elevated energy prices, risking translating through to embedded forward inflation expectations, have created a floor for 10 and 30-year rates that has been tested on a few occasions, but will probably remain in place until there's greater clarity from the Middle East. What I think is notable on the monetary policy front is that the most recent FOMC minutes indicated that the implicit dovish bias contained within the statement is up for revision during Warsh's first meeting. Warsh has a very difficult job cut out for him. Presumably, he gave some assurances to the White House that there would be lower rates on the horizon, but developments in the geopolitical side has made that very difficult to deliver on. I suspect that we'll see some nuance change to the language, but at the end of the day, reiterating the steady state for monetary policy, which at least for the moment appears to be less dovish than was the case 2 or 3 months ago. This has implications for forward break-evens. So five-year forwards and 10-year break-evens have been steadily grinding lower over the course of the last week, which has contained nominal rates, all of which is good news for risk assets. It's good news for equity valuations. And it buys the market, it buys the Fed, and it buys the administration a bit more time to see how this all plays out and flows through to the real economy. I do think Scott did a great job of outlining the primary risks to the real economy. I do think that the consumer, who has seen nominal wage growth not keep up with inflation, we'll increasingly face the headwinds of higher prices as purchasing power declines in real terms. And that could become a problem over the course of the next 2 or 3 quarters, especially if we see any material weakness in the labor market, which remains remarkably resilient, all things considered.
Thanks for that, Ian. I think you outlined well here the interaction there between geopolitical risk, inflation, and the tough spot that the Fed is in right now. You certainly talked about this steady state for monetary policy and a slightly less dovish backdrop. Does this kind of environment meaningfully change the rate outlook from your perspective, or does it mostly reinforce themes that were already in place?
I think it leaves some of our baseline assumptions in place. The Fed's reaction function to higher inflation hasn't changed, and that's important. As long as the market has confidence that if faced with sustainably higher consumer prices, that the Fed will respond hawkishly over the course of time, then we can feel confident with the levels of 10 and 30-year yields in this range. It's only in a situation where Fed credibility is undermined and there's the notion that the FOMC could lower rates even if higher inflation persists simply to boost the economy to appease the administration, that this all becomes a problem. For now, the developments out of the FOMC have been a net positive, and we expect that that will be the case. And we'll learn more about Warsh's commitment to Fed credibility over the course of the next few meetings.
All right, let's bring you both back in maybe for just one last closing question. And we'll start, Scott, with you. If you put the macro and the market pieces together, what's the most important takeaway for clients right now? What's genuinely changed and what has not?
Well, the good news is the U.S. economy continues to surprise with its resilience. Part of the reason why you've seen the stock market hit record high levels every day. It really is batting away shock after shock with nearly a stumble. Inflation remains, I think, the primary concern for both the Fed and investors. But I do think fears of a sharp real consumer spending pullback or overall economic downturn appear overblown at the moment, despite record low consumer sentiment. In fact, some of the recent labor market data suggests that the private sector labor market may actually be firming. We're seeing private sector job growth pick up over the last couple of months. So that's putting a floor under consumer spending. Of course, if we get a more permanent U.S. and Iranian agreement that reopens the Strait of Hormuz without tolls or capture Iranian nuclear material, this would certainly help raise sentiment in the markets and among businesses and consumers. It would certainly help bring down oil prices and inflation. We do think there's a pretty good chance that oil prices will continue to drop towards the end of the year. Our current baseline forecast is that WTI oil will be about $84 a barrel on average in the fourth quarter. So that's a positive that will eventually lead to a lower inflation. Strong productivity growth is also a gift that keeps on giving and will help raise corporate profits that are already at record high levels, raise real wages and potential growth prospects going forward. So the point I'm trying to make is it may not feel like much has changed to the economy and economic outlook since 2025. But I would note that growth could even be much better than what we're forecasting today if we didn't have the war and some of the shocks that it has brought.
All right, thanks for that, Scott. And maybe a similar question, Ian, for you. So you look at the rates backdrop and monetary policy and the like. What has genuinely changed and what has not from your perspective?
Well, I think that one of the things that has changed is we have yet another clear episode where the US economy appears to be demonstrating the resilience that characterized 2024 and 2025 and took many market participants by surprise. The fact that we've been able to weather some of the geopolitical developments and some of the potential fallout from higher energy prices does give investors confidence in the US economy. It gives investors incremental confidence in the dollar and, by extension, treasuries as an asset class. So we do think that this all comes together to be relatively supportive for U.S. assets. And while we do have some reservations about certain sectors with lofty valuations and the underlying momentum somewhat at odds with consumer sentiment overall, it does seem to be a very difficult trend to fade at this point, and we'd be reluctant to do so.
Scott, Ian, thank you both for the insights. I appreciate your perspectives on resilience and optimism. I think it brought an appropriate perspective that balances the risks against what appears to be a positive landscape as well. Thank you, everyone, for listening. As part of BMO's Navigating Geopolitical series, we'll continue sharing timely perspectives in the weeks ahead. And for now, have a great day.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
The views expressed here are those of the participants and may not necessarily represent those of BMO Capital Markets, its affiliates, or subsidiaries.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.